Welcome to the Rosenberg Roundup, a weekly podcast providing investors with key macro and market developments, insightful data analysis, and actionable ideas that are top of mind for the Rosenberg research team in the week ahead.
I'm Dylan Smith, and this is the Rosenberg Roundup. Jacob's in the studio joining me as usual, and even though I'm in a good mood today, we're going to skip the pleasantries and get straight into it because we have a busy podcast lined up. Jacob, what's in store today?
Yeah, no kidding. Very busy today. So for the week in review, we're going to be talking about the Fed. Our spotlight this week is on the worrying U.S. fiscal situation. We have an expert special guest on the show. He's going to help us chew on that, but you're going to have to force me into Canada Corner this week because we do have to talk about inflation. How thrilling.
It is thrilling, Jacob. I can't wait. But before we get to that, let's chat a bit about what's been on our minds this week. What's the best piece that you saw from the research team over the last few days?
So many to choose from, Dylan, so many. But the one that's really got me thinking is the piece that we did on cybersecurity. We've been a little cautious on recommending equities, just given the valuations, but I think we made a pretty strong case for cyber. The firms in that space have to pay for it. Breaches are rising. There's a geopolitical angle. And there's also a big race to keep up with the AI-enabled attacks. How about you?
Well, you'll remember that a few weeks ago I pointed out that if you look at things on a risk-adjusted basis, gold has consistently outperformed Bitcoin over Bitcoin's short little life.
Yeah, you definitely threw a bit of cold water on Bitcoin's latest run, didn't you?
Yes, I did, and made good friends with the crypto bros as a result. This week has seen Bitcoin take a bit of a tumble as ETF flows that were driving the price up slowed down, and the media, as it's wont to do every time there's a Bitcoin run-up, returned to asking the question of how valuations can really be justified. And the piece of writing I would turn our listeners to is an excellent blog by the Bank of England and some of their economists, which argues that the fair value of Bitcoin is zero, a view that I'm very sympathetic to, although, of course, prices will tell you differently. But at the same time as all that Bitcoin action was happening, we saw gold break new highs after the Fed meeting on Wednesday. So you don't even need to risk adjust. Gold has straight up outperformed Bitcoin, at least this last week.
And you know what I would say? You'd be hard pressed to find somebody who's more happy with themselves than Dylan when he gets a call right, especially on the podcast. Anyways, let's get on with the show. All right, back with the Week in Review. Every 6 weeks or so, we have absolutely no choice but to make the Week in Review about the global economic gorilla that is the Fed. So let's get into it.
Nothing happened, Jacob.
Well, you might need to be the one who explains that.
Yeah, fair enough. Powell finally looked like a real seasoned central banker this week in that he was able to speak for a full hour without making markets flinch at all in either direction. He did not change the messaging that the Fed has been so carefully communicating for the past few weeks. And as a result, we saw, fairly nice moves in equities and bonds, but nothing dramatic. The main thing that they did was to keep their so-called dot plots unchanged from the last meeting. That's the median estimate of the committee members and what they think about where rates will be by the end of the year. They've kept that at three cuts. And that has meant that they've just anchored expectations around the same place that they used to be. And that's despite some upgrades, which on the margin should be a bit more dovish and maybe point to a later start or fewer rate cuts. That's not the case. Even though GDP rose on their projections and inflation's a little higher too, markets kind of understand that that's just mostly reflecting a higher starting point based on the data we've seen so far this year and the strong end to last year. So overall, a very consistent message. Rate cuts likely to come in the summer, probably in June. And one of the things is that Powell echoed something that we've been flagging quite a lot, which is how strange the seasonal adjustment patterns are to the January and February inflation numbers, which basically means we don't trust those numbers very much. And on the margin, it sounds like he doesn't either.
You know what, Dylan? It also sounds like you got what you expected on the balance sheet, too. So I'm starting to think that we might have to retitle this episode to Dylan Runs a Victory Lap for 20 minutes.
Correcto mundo. Although the call really was just that nothing would happen. This is talking about quantitative tightening and what we would get there. In the January meeting, Powell promised that the committee would be discussing changing the pace of balance sheet rundown in this meeting. But it then became quite obvious that if they started doing that or made a big announcement this meeting, they risked confusing markets and leading everyone to think that they were easing before they were quite ready to ease yet. And they'd probably rather want to pair it with a rate cut or with an actual easing of policy, right? The communication challenge, as we spoke about a little while ago, just became too hard. And that's exactly what happened. He just punted it, didn't talk about it in the statement. When there were questions from the media on it, he said, yep, we're still looking at it. We'll slow it down eventually, but not yet.
Sounds like it was a pretty sleepy Fed meeting, but I guess, that's probably a good thing. Anything else that you wanted to flag from this week's data?
A little bit. The main news was some positive data from the housing market. We have been seeing for the past few years a big supply boom in large multifamily rental units, and that's now coming into the market and putting a lot of downward pressure on rent. So a good tailwind from the inflation outlook in terms of rent being quite a large part of the consumer price index and consumer spending. We also saw homebuilder sentiment up. So an overall a good March for the real estate sector, but also a reminder that the rest of the data we've been seeing in the early part of the year, from retail sales to manufacturing, industrial production, even housing starts, has been pretty dismal. And it does look like GDP growth is set to slow, if not actually outright contract. Next week, we have a relatively light calendar until personal consumption expenditures, which drop on Friday. That's an important release because it's a big chunk of GDP and gives us a big insight into where the Q1 number for growth is going to land. It's also an important inflation gauge and may have a slightly different signal than CPI, so we'll see what comes there.
Yeah, they really decided to sneak it in on a holiday, huh? I don't know if that means there's going to be something in the stats that the folks don't like about it, but as always, we'll make sure that we cover it. Now the part that I'm really excited for, a bit of a special spotlight on the U.S. fiscal situation. We've been writing a lot about this. You had a piece on Tuesday arguing that when we say higher for longer, quote unquote, we really should be thinking about the Treasury more than the Fed. And last week we put out a big special report on what it will take to resolve the debt problem. We're also speaking to a special guest who we'll introduce shortly, but Dylan, why don't you set us up by explaining why we should be paying more attention to this problem?
Yeah, we really should be. This matters a lot for investors and for the global economy as a whole. As a reminder, the U.S. debt to GDP ratio, which is the sort of key measure of the fiscal situation at any given time, that ratio stands at 120% of GDP. And based on current projections from the Bipartisan Congressional Budget Office, it's going to rise over the next decade because there are no projected surpluses in sight. Congress is totally locked over its ability to reduce the budget. And so we're approaching near record high levels, and importantly, far higher than the very high post-World War II debt that took a long time to dig out from. It's very hard. It's very, very hard to say that this doesn't matter for markets, but it is also a slow-moving issue, and fiscal problems tend to be ignored until they're an actual crisis. So the risk kind of fades into the background noise instead of getting the attention it deserves, and that's basically how you get to the crisis. As we'll hear in a minute, it's markets and ordinary investors who have the power to force the hand of politicians to deal with the problem.
Yep, and we covered all that and more in our latest special report.
Yes, published last week. We'd encourage listeners to check it out, link in description. Basically, what we did was use Canada's crisis and consolidation of the 1990s to argue that there actually is a roadmap available for the U.S. to follow. And the corollary of what we say there is that there's something to look out for in terms of evidence that things are not on track for investors, right? So there's a roadmap for everyone. But the one thing we didn't manage to touch on much, although there was a bit at the end of the piece, is the counter argument we hear quite a lot that the U.S. is not like other countries. That because America provides the world with the benchmark basic risk-free asset, the U.S. Treasury, and because it's the global currency for reserves and for trade, that it doesn't really follow the same rules of fiscal gravity as everyone else, and so there's nothing to be worried about. Debunking that argument is a very complicated thing to do, which is why we thought we'd bring in an expert to help us through the discussion.
Certainly, and we're very pleased to have our first external guest on the podcast today. We have University of Toronto assistant professor and financial economist Jason Choi. Dylan, he's the academic equivalent of you. He focuses on the interaction between macroeconomics and the financial system, and he spent time working at the Kansas City Fed as well. The reason we reached out to Jason specifically to chat with you is that he's just put out a working paper with co-authors on exactly the topic you just mentioned. So with that, I think I'm going to throw it over to you to kick things off.
Jason, thanks for joining us on the podcast today, and let's get straight into it. Everyone knows, or will say that they know, that the US is in a strained fiscal position at the moment. But nobody seems to be doing anything about it. Policymakers won't act, or can't act, and at the same time, markets are not flagging any concerns through pricing channels, or indeed any other channels. The academic community, which you're part of, has the luxury of distance and time to assess the situation. So, my first question for you, how worried are academics about the US's fiscal standing?
No emergency alarm bells are ringing, but it's kind of an unsettling situation we find ourselves in. And, historically speaking, this situation we find ourselves in kind of happened rapidly because, so the key metric that when we talk about US or any fiscal issues is the debt to GDP ratio, right? And the debt to GDP ratio used to be around 100% following the financial crisis for about 10 years, and it's been pretty steady. And at the time, people were talking already about, is this too high? Is this too low? But the key there was that the interest rates were very, very low. So there were prominent economists like Olivier Blanchard who had been saying, this is the time to borrow. It's totally fine to be running 100% debt to GDP ratios. But then because of the global pandemic, almost overnight, it shot up to 130%. And now we're down to about 120%, but still very high. And now we're also in a 5% interest rate world. So I think this is slightly new territory, and academics aren't really sure exactly how to feel about it. It's a little unsettling.
Cautiously concerned is a great way to put it. You said alarm bells aren't ringing just yet. Why not? Is that because the can is kickable and there's still some time to avert a crisis?
That's a good question. So there's definitely been renewed emphasis in thinking about U.S. fiscal issues. I think part of the reason why emergency alarm bells aren't ringing is because the markets aren't reacting with emergency alarm bells and policymakers aren't either. So I think that's why academics are also kind of on pause on how to feel about this.
Feels like everyone is watching everyone else to see who panics first. One potential explanation that I've come across a lot is that the US is in some sense special. It's not like the other girls in Southern Europe or in the emerging world. Different rules apply stateside. So can you explain for us the notion of US fiscal privilege?
Yeah, when we think about sovereign debt and fiscal issues, the US is definitely special, and I have finger air quotes right now. And one key sense in which it's special is because A, it's the reserve currency for the world, and then two, US sovereign debt seems to be considered ultra safe, and that it's like the safe haven default asset almost that you just pivot to whenever there's a crisis. And which is why when you see crisis in the US, people still pile on to US treasuries. You go into where the problem is. And so this specialness kind of gives the US several privileges that other countries don't have. And there's a bunch of these privileges, and you kind of group these, and as a group term, you call it exorbitant privilege. So exorbitant privilege, is actually first attributed. It was attributed to Charles de Gaulle, the former French prime minister, but it turns out it was actually his finance minister who said it. Originally, what exorbitant privilege meant is because the U.S. is the reserve currency, the rest of the world central banks want to hold U.S. dollars. In exchange, you have to give the U.S. their currency, but the U.S. doesn't really need to hold yens or Canadian dollars for liquidity purposes. So they can spend it and invest it. So this kind of mismatch that the U.S. kind of gets free money from the other countries was how the term exorbitant privilege was first explained as. But now it's more of an umbrella term, and it contains other things like this apparent treasury premium that the U.S. Government interest rate is kind of artificially lower than what we think it should be because of this ultra-safe attribute. You mentioned in your question whether the specialness allows the U.S. to carry more debt. And I think you're referring to one of my recent work with some co-authors. So this is work with Duongdeng, Rishabh Kirpalani at the University of Wisconsin-Madison, and Diego Perez at New York University. In this paper, let me try to kind of give you a gist of this paper. In this paper, we tried to think about how much does the U.S. benefit from having this treasury premium. So we're thinking about a specific exorbitant privilege, which is this treasury premium. And I should say that this treasury premium, the way you find it is by trying to compare U.S. treasuries to what U.S. treasuries should be like. And there are many ways to do this. And what we try to do is we think a quick back-of-the-envelope calculation on how much does the U.S. benefit from this would be to just say, well, currently the U.S. has $44 trillion in debt as of today. And they get to save about 60 to 100 basis point in interest rate payments on this. So you can kind of multiply that, and that'll give you, I think, something like 200 billion. But in that exercise, what you're doing is you're comparing the U.S. to a counterfactual artificial world where they don't have this discount of 60 to 100 basis point. But they're still borrowing 44 trillion, right? So you're just kind of giving them a price discount where you're fixing the quantity. And so in our paper, we thought, well, the specialness probably allows them to have a different quantity as well, not just a different price. So the question is, how much would the U.S. debt capacity be different if they didn't have this treasury premium? In our paper, we build a model to study this, and we find kind of the short conclusion is that the U.S. debt capacity would be about up to 30% lower based on your different assumptions if it didn't have this specialness. So not only are they getting a price discount, they're able to carry 30% debt to GDP more because of the specialness.
That's the key, that ability to carry a higher debt load. And that might explain the lack of panic we were talking about earlier. But another way to frame this issue is that, that 30%, if you think about it in relation to the accepted 90% threshold that everyone sort of agrees is the point at which you should start getting very concerned about debt sustainability. So unless my math has completely failed me, if you add an extra 30% on top of that, you get pretty close to the 100% debt to GDP ratio we're at now. So I guess my question at this point is, even with that privilege, is there anything else we should be worried about, even if the debt is carryable or kind of only just carryable?
Yeah, so there's academic literature that thinks about what are the downsides to just having higher debt, even if it is manageable. And so, for example, like one of it, and it's related to some other work that I have, is that U.S. Treasuries seems to crowd out financial intermediary liabilities. So the idea here is that the U.S. Treasuries are viewed similarly to like bank deposits. And so all else equal, if there's just more U.S. Treasuries in the economy, then there's going to be a portfolio adjustment towards that and away from bank deposits. And so that hampers financial intermediation through banks, and it makes bank lending more expensive. So there are these kind of effects, but there's also pros, which even if you don't think about what the government would be doing with this money, they could be investing in productive infrastructure, etc. There is also just benefit in having more U.S. Treasuries because it is a safe asset, and this is something that the global economy values and uses. So there are pros and cons. The real first order question is whether it's even sustainable in the long run. And that is a question mark.
A huge question mark indeed, and a good cliffhanger to end on. Jason, that's all we have time for today, but it was excellent speaking with you, and I'm sure we'll be back whenever we need some deep insight from the academic community. Thanks very much.
Yeah, thank you for having me, Dylan.
Jacob, pop on your toque, throw on your checkered flannel, and grab your axe, because we're heading into the backcountry of Canada Corner.
I'll be dead honest with you, Dylan. I did not miss when we skipped Canada Corner last week.
Actually, we might have to upgrade it, because there's a lot to talk about. Maybe Canada Kitchen? Canada Commons? Canada Caboose?
We can think about it. But let's get back to this week's episode. What are you excited about?
Core inflation. It's coming down really fast. The Bank of Canada has lots of different ways to measure core inflation and underlying price pressures. And after a recent stall, we've seen a big return in all of the measures to nice disinflation. And they're almost at the upper end of the target from, well over 7% at the peak. So great news there. And that's because at the minutes of their last meeting, which also came out this week, those minutes showed that the real focus of the Bank of Canada's Governing Council is core inflation and underlying price pressure. So all they really have needed to see in order to start cutting rates is that disinflation to continue and for price growth to keep trending down. And that's come alongside, since that meeting, it's come alongside a bunch of recent data that makes us increasingly convinced that the Bank of Canada needs to cut rates sooner rather than later. I was on Bloomberg during the inflation release earlier this week and was asked about, if the US isn't cutting yet, can the Bank of Canada really cut? What about, the exchange rate? What about inflation? To which we say, that shouldn't be holding them back, right? There is nothing wrong with a slightly weaker loonie, especially when competitiveness and manufacturing productivity in Canada is very, very weak. So we don't think that should stop them from cutting. The one fly in the ointment is the housing market. And there's a real concern that if they start easing policy, there'll be a rush of money back into the housing market, and that will push up house prices and make it harder for them to cut again. But we actually think that that doesn't have much to do with when the first cut is. It's more about the pace of cuts afterwards. And they can make some adjustments and then observe what happens and, change course accordingly. So that shouldn't stop them from moving, given how necessary it feels like a easing of very, very, very restrictive policy is for the broader economy.
So if I'm understanding you right, I should probably be selling my CAD right now.
Yeah, that definitely points to Canadian dollar weakness. And that's not necessarily a bad thing, as I said. Hey, just buy some gold.
Sounds like a good idea, and it also conveniently brings us full circle.
Well, with that, then, I think it's time to wrap. I'm Dylan Smith, you're Jacob Rosenberg, and that was a long version of the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.